you see? Can you see my screen here?
Yep.
Yes. Okay. Yeah, so I start with a short video here, and then we'll use it as a context for our discussion.
Another day, another story. A small cafe owner in Manhattan named Alex had always been passionate about his cafe and dedicated countless hours to serving delicious food and creating a warm, inviting atmosphere for his customers. However, when it came to taxes and financial matters, Alex felt like he was in over his head. He knew he had to pay taxes, but the complexities of tax credits and deductions left him feeling confused and overwhelmed. One sunny afternoon, as the cafe bustled with patrons, Alex noticed a friendly stranger sitting at the counter. The stranger struck up a conversation and introduced himself as Mark, a certified public accountant, CPA. Intrigued by Mark's profession, Alex couldn't help but ask a few questions about taxes. Mark was more than happy to chat and explained that he helped individuals and businesses navigate the complexities of the tax code. As they chatted, Alex's curiosity grew, and he mustered the courage to bring up a topic that had bothered him for a while: historic preservation tax credits. Alex had heard from unreliable sources that his cafe wasn't eligible for these tax credits, and that had left him feeling disheartened. Mark listened attentively and assured Alex that eligibility for tax credits depended on specific factors, and there was a chance his cafe could indeed qualify for historic preservation tax credits. Mark took a few minutes to explain the details and requirements of the tax credit. He emphasized that historic preservation tax credits were designed to incentivize the restoration and preservation of historic buildings, which aligned perfectly with the unique charm of Alex's cafe building. Alex's eyes lit up with hope as he realized that he might have been misinformed all along. But the surprises didn't end there. Mark went on to mention the employee retention credits, which had been introduced to support businesses that hadn't let go of their employees during the COVID outbreak. Alex's heart swelled with pride as he recalled the challenging times when he had worked hard to keep his dedicated staff employed, even when the cafe faced financial uncertainties. Feeling grateful and enlightened, Alex decided to take action. With Mark's guidance, he initiated the process of filing for both historic preservation tax credits and employee retention credits. The journey wasn't without its hurdles: paperwork, documentation, and regulations to navigate, but Alex was determined. Mark's expertise and patience proved invaluable as he worked closely with Alex, ensuring that every detail was attended to. The efforts paid off. When tax season came around, Alex was elated to see his tax liability reduced by a whopping 70%. The savings he gained from the tax credits were a testament to his hard work and Mark's guidance. Alex's cafe continued to thrive, and he couldn't help but share his success story with everyone he met. From casual chats with friends to conversations with fellow business owners, Alex encouraged everyone to explore the potential of tax credits. He stressed the importance of seeking professional help and working with CPAs who have a deep understanding of the tax code. He highlighted the pivotal role Mark played in turning his tax confusion into clarity and financial relief. In the end, Alex's story served as a reminder that misinformation can lead to missed opportunities. Many people, like Alex, might be paying more taxes than they actually need to, simply because they're unaware of the tax credits available to them. Alex's journey also underscored the importance of having the right professional guidance. He urged people to consult experienced CPAs like those that achieve tax relief who could educate them about their eligibility for various tax credits and expertly guide them through the application process. And so, with a renewed sense of purpose, Alex continued to share his story, helping others discover the benefits of tax credits and the power of professional assistance. Through his experience, he hoped to empower individuals and businesses to take control of their taxes, reduce their liabilities, and invest in the growth and success of their endeavors.
Yeah, so this is the intro story to the topic of tax incentives, and it made a point about the misinformation. So the achieved tax relief is one of two entities, another one being Coca CPA under the trademark of the B dance. So like one of the types of bee dances is known as the dance of a deceived bee. So what happens is when the bees go through different channels and tunnels, they tend they tend to they tend to communicate when they go back to the other bees and communicate the source of nectar. One of the drawbacks could be that they may be communicating the not precise distances, but more of the perception of their vision apparatus. So that can lead to distortions, and as a result, the other bees, instead of actually finding the source of honey, will be way off from that source. So it's one of the challenges is the lack of information that small and middle market businesses have about the variety of tax incentives available to them. So on this slide here, it's I want to focus our attention on the value cycle, and that's actually a segue to a different service that we provide. It's called color accounting and financial literacy. So instead of using debits and credits, we use color: green for uses of funds, that's essentially debits, and orange for the sources of funds, that's credits in their natural condition. And you see, so that's how the value cycle moves here. So we see three major type of revenues, three major types of sources of funds: liabilities, equity, and revenue. And then we see uses of those funds: assets and expenses. So the idea is to build the assets and long-term value for the business. But interestingly enough, if you look here at the sources of funds, it's this model doesn't capture one other very important source. I mean, if we talk about corporate accounting at its basic level, it's a good enough model, but it does miss very important source of funds, which is government and government incentives. So when the businesses need infusion of cash to help them grow, that's the government can be a big source of the tax credits. And what's interesting is that with the Inflation Reduction Act of August 2022, it became even more so, because prior to that, a lot of credits were non-refundable. Well, with the Inflation Reduction Act, a lot of credits became refundable. So that highlighted the importance of that government incentive source of funds. Yeah, so this is a brief agenda for today. Talk about different types of credit and credits classification by business stages, R&D credit, and then we focus a bit more on historic preservation credits. Yeah, so this is the scannable form to, if you know, like, if you're aware of any businesses that may want to explore what credits are of use and available to them. So if we talk about about refundable and non-refundable tax credits. So non-refundable are those that can reduce your tax liability to zero, but do not provide refunds beyond that point. So you cannot get cash for the access of the tax credit over tax liability. So we can name some examples of non-refundable credits. That's adoption credit, lifetime learning credit. Lifetime is like beyond bachelor's degree. Residential energy credit, work opportunity credit, retirement savings contribution credit, and mortgage interest credit. That's the examples of non-refundable. Then if we talk about refundable tax credits, on the other hand, then if the credit exceeds the tax liability, the taxpayer can actually receive the refund check from the government for the amount of the excess of the credit over the tax liability. And and as I mentioned, Inflation Reduction Act was a true game changer because it really made a lot of credits refundable. Examples of the refundable tax credits included earned income tax credit, which came about as a result of the CARES Act, and then it was modified several times, so it went through several iterations. Initially, companies with PPP could not apply, but then eventually they could, and this program expires. This program for employee retention credit for the businesses that kept employees on the payroll during COVID expires in 2025, and that's for credits related to 2021, and for employee retention credits related to 2020, it expires in 2024. For 2020, the business can get up to the maximum 5,000 per employee, and for 2022, the business can get up to 7,000 per employee per quarter, but that's limited at 3 quarters, so maximum of 21,000 per employee for 3 quarters of 2021. But then there is one caveat: there are qualified recovery startup businesses, and those are defined as businesses that emerged after February 15, 2020. So those businesses that started after that date and had employees, there is an exception for them for the fourth quarter. So those actually can qualify for all 4 quarters of 2021. So that will bring it to the total of 28,000 for 2021. So if we talk about additional 5,000 in 2020, so the maximum potential is 33,000 per employee for both 2020 and 2021. So if the company, so imagine that the company qualifies to the maximum credit, which is like limited to 70% of eligible payroll expenses. But imagine that it does qualify, that the maximum potential is 33,000 for years 2020 2021. So imagine there are 10 employees, 10 W2 employees, so we're talking about 330,000 tax credit that company can receive, that can really boost the company's cash flows. Then we have partially refundable credits. That's the credits where a portion of the credit can be refunded if the tax liability is reduced to 0 using the full credit amount. So if we talk about American Opportunity Tax Credit for post-secondary education students, that's a type of the partially refundable credit. And then child tax credit initially was structured as partially refundable, but subsequently became fully refundable. This is a very useful chart here that show, because businesses often ask how to know which credits pertain to us out of the myriad of different credits. How do we navigate the landscape? What's really applicable to us? So this chart actually breaks it out, the main credits that are applicable to different businesses by stage. And the stage, for the purposes of this chart, is defined as by the number of employees. So you see, like for employees, for startups, like for 1 to 20 employees, then phase 2, companies with 20 to 1,000 employees, and phase 3, companies with 1,000 or more employees. So you see, you can read here different types of credits that would be applicable in these scenarios. So you see, like here, the paid leave is a good idea for these for startup and growth businesses up to 1,000. But you see here this employee retention credit that you discussed. I mean, it's a fair game. It's a fair game for different employees. Initially, employee retention credits was limited to companies with 500 employees or fewer, but then subsequently it was expanded to capture a much broader range. Then you see, like, we have federal disaster zone credits for all three stages. And this one is very interesting. We'll zone in a little further down the road. R&D credit. Many more companies qualify than they think they can qualify. See, job creation, also known as work opportunity tax credit. No, it has to do with employing people, minority people, and veterans. Really, if somebody has been out of workforce for a very long time, hiring people like that can lead to tax credits. Then we have capital investments credits, training grants credits, pollution control credits, state unemployment claims management. This one is very important. It became very important during COVID because that unemployment rate is a function of satisfying the unemployment claims. And these unemployment claims got really out of whack during COVID because the companies were nilly-willy with their policies. They were not looking too closely about what claims they were satisfying and which one they didn't. So because of that, many companies faced a steep increase in their unemployment tax rate because a lot of their employees, like ex-employees, like were filing for unemployment claims. And the management of that unemployment claims is very important, especially for bigger employers. Then for instituting systems such as I-9 verification to make sure that these people have legal authorization to work, there are credits available for that too. And then we have payroll tax consulting services and Affordable Care Act reporting. See, and that's applicable to all three stages. When we zone in specifically on R&D credit, that's a very interesting type of credit because it provides really good incentives to businesses to invest in research and development activities. And often companies think, oh, like it's only for big companies like Procter and Gamble, like giant companies that have deep pockets and they can invest in research and development companies. So few small and middle companies realize it doesn't have to be like breakthrough novel accomplishment in the research area. So the idea behind this credit is the government understands that naturally companies wouldn't want to invest in experimentation unless they know for sure that there will be a tangible ROI on that investment. But if we go that route, then a lot of companies will be prevented from exploring new initiatives of bettering their processes, their procedures, or software. So the government incentivizes this kind of activity by this R&D credit. And for tax purposes, it's not novelty-based, as a lot of people think. It's activity-based. It's a nature of activities undertaken, a scientific approach used, and we talk a little bit further in more detail about that. In a nutshell, our R&D tax credits are designed to offset a portion of the costs associated with qualified research activities, encouraging companies to innovate and develop new products, processes, and technologies. Businesses must engage in qualified research activities that meet specific criteria, and it has to do with improving existing products, enhancing manufacturing processes, conducting experimental activities to resolve technical uncertainties. So I had a client in upstate New York, and they are in the pharma label industry. And you will think, not a big deal, they're just making like stickers, these labels for for drugs. And you would think, what's the point for this company to apply for R&D credit? But you see, if you really think through that credit, yeah, it seems a kind of a basic model of printing labels. But at the same time, this company hired the team to improve their process of printing those labels more efficiently. This company can qualify for R&D credit, even though the business itself doesn't appear like very hard science. However, there are hard science processes related to this label printing process, so they can qualify. R&D tax credits typically cover various expenses related to research and development, such as employee wages, supplies, equipment, and contract research expenses. Because if you contract with the third-party organization, worked with one organization a while back, and they were doing pharma research, so their entire business model was based on being a contracting research organization, or CRO. So other pharma companies would actually hire this company to conduct the research and development activities, and they would still, the companies that contracted with CROs are still eligible for claiming, even though they don't. It doesn't have. So the point is, it doesn't have to be in house. You can contract with a third party provider for those research activities and still be eligible for the credit. The calculation can vary, but basically we need to figure out the base amount, and the base amount is based on the last few years of research and development of activities, and we take 50% of that gives us a base amount, and then we take the current year eligible research and development activities, we develop the calculated base amount, and then you can get, there are 3 different methods to compute the credit, but you can apply either 20% or 14%. So that's a rough calculation under Internal Revenue Code section 41. And there are corresponding state equivalents. A lot of states offer their own R&D tax credits in addition to the federal credits, and different states have their own rules for figuring out which expenses are eligible and the calculation formula. And businesses usually claim them when filing their annual federal and state taxes. It requires detailed information about qualifying activities, and these credits provide financial incentives for businesses to invest in research and innovation, and that can improve companies' cash flow and push the company to allocate more resources to these dubious or uncertain research activities without the certainty of the outcome. These activities contribute to fostering innovation, driving technological advancement, boosting economic growth by encouraging businesses to undertake high risk, high reward, and I would add here like low certainty activities. Due to the complexity of R&D tax credit rules and calculations, businesses should consult with professional tax consultants to make sure that all the I's dotted and T's crossed. They'd like to maximize the acceptance of the credit in the first try, rather than go back and forth with requests for additional evidence and lose valuable time and in actually getting the needed cash flows. Prior to 2015, the R&D tax credit was only applicable to income taxes, but then here we have 2015 PATH Act comes along, and then up to 250,000 could be applied against payroll tax liability. And you're like, why is that? Why is that important? Well, think about it for a moment. We talk about small and middle market. A lot of these businesses don't really care about the reduction of income tax liability, but they do have employees, so they could really benefit from the payroll tax reduction. So that was like a great breakthrough for a small and middle market. And then like August 2022 rolled around with the Inflation Reduction Act that we mentioned before, and it raised the benefit to 500,000, the limit to 500,000, aiming to support qualified small businesses and promote innovation. And you see, it was specifically for small businesses. Eligibility criteria for qualified small businesses remain unchanged. And we can qualify small business eligible for the payroll offset is a corporation, partnership, or S corporation, which has less than 5 million gross receipts in the current tax filing, and no gross receipts prior to a 5-year window that includes the tax filing year. We have a section 174 capitalization requirement that came as a result of the Tax Cuts and Jobs Act. And this one was a big game changer too, because until 2017 tax reform by the Trump administration, it was like expensive. You could take this research and development eligible cost, you go through the formula, you compute that R&D credit, and now like I backtrace because we are talking about like we are talking about the eligible research costs. So back before 2017 tax reform, the companies could expense those, but then the reform came rolled around, and then it said, you know what, now you have to capitalize that and amortize it over 5 years for domestic projects, R&D projects, and 10 years for foreign projects. So that changed the rules, and it caused a lot of backlash because companies wanted to keep on deducting those for tax purposes, and now they can't. So now it's a matter that there were a lot of stakeholders, such as American Institute of CPAs, pushing for changing it back to the expensing rule. And so far, like the legislators are looking for the appropriate law and the appropriate vehicle bill to which they can attach the change to section 174 and make those expensible again for tax purposes. Yeah, here's this point. So that was courtesy. I mean, that was a part of the tax reform, but you see the effective date is here. So starting January 1st, 2022, companies can no longer deduct research and experimentation expenditures. And look at this terminology. Terminology changed also. Remember how I kept referring to this credit as R&D? Well, then tax reform of 2017 changed it to R&E, research and experimental R&E expenditures. So some people get confused. So you will hear some people say R&D or R&E, but that's a result of this legislation changing terminology. But the point being, effectively January 1st, 2022, that's when companies lost the ability to claim these research and development expenses as a deduction. Now they have to put it in the balance sheet and amortize over 5 years, as I stated before. But you know, they're looking for a vehicle to undo the change, for the legislative vehicle to undo the change. And TCJA, the 2017 tax reform, broadened the definition of R&E expenses. So now it includes development of software also. Yeah, so here a myth, and I alluded to that briefly at the beginning, that many businesses think it's only for high-tech or scientific industries, but in reality, it captures a wide range of different industries, including manufacturing, software development, food production. They can qualify for R&D credits. Yeah, another myth that it should be a super novel breakthrough, but really R&D credits relate to incremental improvements, process enhancements. Even unsuccessful projects can still qualify because it's activity based. So there are four main criteria for it's a four-pronged approach basically. So the first criteria is that the outcome is uncertain. Uncertainty of the outcome. The second criterion is that scientific approach must be followed. So that means that there must be a hypothesis. Certain hypotheses, we are testing this hypothesis. If this hypothesis doesn't work out, we need to replace it with different hypothesis. We must have a statistical sample that we are testing to verify if the hypothesis is true or not. So we are following the rules of the scientific discovery. And then another criterion is it must be the processes or systems related to the STEM fields. It must be something related to hard sciences, science, technology, engineering, mathematics. And I actually have Shubham with me here, and he's about to graduate with MBA in finance from Stevens College. It's very it's very STEM focused college. Like as an interesting like caveat, they some colleges added accounting, and they changed STEM to STEAM, like steaming as the engine of innovation and progress. So some colleges, as long as accounting is very computer science heavy, now it qualifies as STEM. So these foreign students that come can qualify not only for 12-month authorization, they can qualify for a 36-month work authorization post college. So it's when it pertains to accounting. So certain programs like Columbia Finance, they actually added accounting into STEM because it has a lot of very computer science heavy curriculum, but they are going to add accounting to STEM in general. So when we talk about tax planning, especially, some people come to me at the end of the year, and then they want to make some adjustments to their taxes. And there are certain things we can do on accruals and things like that to help the company. But it's too late for substantive changes, because the idea is to plan ahead, like by month or by quarter at least, to get all those ducks in a row. So we talk about the eligibility for R&D credit. You see it when some people are majoring in STEM, that's already investment in their preparation, because if they go to the tax field, like Shubham is interested in going the CPA route and working with tax incentives, especially with R&D credits. I mean, if he majored in STEM in the Stevens Institute of Technology, he will be more prepared to engage in the requirements of the scientific approach. And the fourth requirement, the four-pronged approach is the capability testing. There got to be either internal teams or external teams, research organization working. So with the hope of ensuring the success, but as I mentioned before, it doesn't have to be successful. It can be the project they invested a lot of funds in the process, but ultimately it didn't lead to any major discoveries. I'd like Shubham to share a few things about the Stevens Institute of like Stevens College STEM program and how it relates to R&D credit. Shubham.
So, Stevens Institute of Technology in Hoboken is mainly a STEM institute with focus on masters in sciences and a few business courses, but also they relate to STEM fields. All of the concentrations at Stevens are STEM, even for a business degree as well. As you move forward with any kind of finance, we have to see that, especially you're saying that R&D credits, right?
Yeah.
So research and development credits are ultimately useful because earlier the accounting practice was not regarded as STEM, but now everything has been integrated with technology, and now tools are being developed uh, with accounting, and that's what's being taught at our school in corporate finance, as well as we have taxation courses as well. So R&D credits, I mean, the new developments have made it quite easy for people to actually.
Hey, Shubham, let me make this question a little more specific to you. So imagine some company, like some small and middle company, tells you, I'm not like we don't have people with the scientific background. We're not sure we can follow scientific approach to satisfy one of the four-prong approach for R&D. What would you tell them? How they can go about the scientific approach requirement of the process?
I mean, when it comes to R&D credits, it's not absolutely necessary that you need to be, uh, developing the most innovative scientific product. It needs to be associated to a scientific product, and like you said, there are many myths that people think that it's not for projects that have already been developed. They think that it's only up for ongoing or future projects. So companies that are doubtful that if they're eligible for the R&D credits, it has to be hard sciences, but it doesn't have to be. You need not develop a product from scratch. That's what I'm saying. You need not go into the scientific depths to qualify for that R&D credit. If you are associated with a scientific product, be it any STEM product, that is, like earlier, I think we were talking about a pharmaceutical company and how machinery is used in labeling for those pharmaceutical companies could also qualify for research and development credit.
Yeah.
And so there are many opportunities for companies to do so, and I think you are doing a great job educating them in that regards.
Okay. Okay. Thanks. Sure. Yeah. So it's in a nutshell, it's a time-consuming process, and so it requires tax expertise. And then another myth is that only laboratories can do it, and you see that's not true. It's not only in the labs. It can be activities such as product testing, prototyping, and even solving challenges in day-to-day operations can qualify as eligible research. Yeah, and another misconception is that R&D applies only to new products, but that's not the case. It can be implemented with existing products, processes, and technologies, as long as as the goal is to make them more efficient or enhance them. So enhancing or making more efficient would qualify. It doesn't have to be a brand new product. Or some companies think that past projects are ineligible, and they think if they assume that if they are only available, they think they are only available for ongoing and future research. But businesses can amend prior year returns and still claim them. So that's a good opportunity for many businesses that, yeah, if you didn't claim in the past, but you want to claim them, we can still amend tax returns and still claim, you can still get it because we amend the tax returns, and that company claims R&D credit. Now, another type of credit we'll talk about is historic preservation tax credit. And when it comes to this type of credits, I wasn't really experientially familiar with this until working for LTC Health Solutions in Columbia, South Carolina, with Ed, Ed Trussell is the CFO there. And Ed worked on multiple construction projects pertaining to historic preservation tax credits and facade preservation easements. So I'd like Ed to comment on the value he's seen from these credits and briefly describe the process.
Hi. Yes, I had the pleasure of working with Vasile for several years in Columbia, South Carolina. And actually, Vasile and I went to graduate school together at Wingate University in North Carolina. That was all. We also got to know each other well, working on various school projects. The group that I work for is a closely held family group, and Vasile also worked with that group as well. And they had a lot of experience over the years of developing and building their own nursing homes. And Columbia, South Carolina's downtown kind of had a revitalization. So they decided to explore looking at these historic buildings in the historic district for tax credits and places to open new businesses. And kind of the number one thing and the number one reason to do historic tax credits is for qualified rehabilitation expenses, you get a 20% federal historic tax credit, a 25% in South Carolina. I'm not sure what New York's rate is, but in South Carolina, we get a 25% state historic tax credit. And then there's also a 25% South Carolina abandoned building tax credit. And in some situations, which only qualifies for one of our projects, there's a textile tax credit. Being in the South, there were a lot of textile mills that kind of went away and left properties. And so I think you only get to choose in South Carolina between the abandoned building or the textile, whichever qualifies in that situation, but you can't have both. And there's some different rules that make one more applicable than the other. And I'm sure it's the same, whatever jurisdiction you're in. So kind of a big way that a developer can use this is to get their equity back out of the project. And the way you can do that is by, if you have a big tax liability, you can use that, the credits yourself, or you can have an investor buy into the business and they get the credits. And so you're essentially selling the credits to them because they put in equity to receive the credits, and then you get back the cash that they put in. And assuming the rest of the construction costs are paid off by a note. When you sell the credits, usually there's a tax credit marketplace. We've always done this through attorneys, so I'm not extremely familiar with the tax credit marketplace and how it operates. But usually there'll be separate terms and bids where different groups will be willing to pay a certain percentage of the tax credit. For example, say I'm looking at a sheet for one of our projects. There's about $1 million of historic credits, and they're willing to pay, in the high 70 percentiles for that. And then for the state credits, they'd be willing to pay, in the high 60s or low 70s percentage points. And so they would buy into the business and temporarily own about 98 or 99% of the business, so that they receive 98 or 99% of those credits flow through to them. And they put actual cash in the business for their equity percentage of the credits. And then the developer gets to take that money out. There's also some incentives in Columbia, South Carolina, which I think there's some similar in New York City, although I'm not very familiar with it. Where if you put in a certain percent of equity yourself and you have a certain percentage of qualifying expenses, you get to keep the building's assessed value the same amount for 20 years. So that's another way that we use it. Some examples of ideas that we've had that qualify is we built a restaurant and bar that has 7 bowling lanes. And the bowling alley, equipment is all permanent fixtures, and the bowling lanes are permanent fixtures. And so they all qualified for the federal tax credits, the historic tax credits, and then we got the abandoned building tax credits for this particular project. And all of the bowling expenses qualified. Another example is we built a brewery for brewing beer in a qualified opportunity zone, but that's a conversation for another day, because that's a rabbit hole of discussion there. But all of the brewing equipment that we bought was a permanent fixture, and it's all wired in. You have all the pipes for the water and the beer, and so it becomes a permanent part of the building. And so that brewing equipment also qualified for the credits. And so if you're ever considering, or any clients are ever considering working with a project with these credits, figuring out what the qualified rehabilitation expenses are in your jurisdiction are, and I'm working with an attorney or other expert on whether or not your concept and many of the expenses you would have in your development concept would qualify.
Hey, thanks so much, Ed, for that overview and sharing some examples too. So when Ed was talking about permanent fixtures, and we start talking about that it's not only building, but it's also about components of that building. And then when we split the building into structural and non-structural components, so then if we talk about structural components, then they would depreciate for commercial purpose buildings over 39 years. However, non-structural components can be allocated their own useful life. So it can be 5 years, 7 years, or 10 years, depending on what buckets we are talking about. And the way to allocate those, to split those components, various components in different buckets, we can accomplish it through a cost segregation study. So it requires specialized expertise. And we work with the partner firm that conducts these cost segregation studies, the end goal of which is splitting structural and non-structural components into buckets. So the advantage is that if we say, oh, we depreciate the entire building over 39 years, it's going to result in much smaller depreciation deduction. But if we split it into various buckets, and some of them are depreciable over 7 and 10 years or so, then we can really maximize the benefit of depreciation. So once the partner firm does the cost segregation study, then that's where CPAs come in, and then they apply the results of the cost segregation studies to the taxpayer's company tax return, thereby maximizing the depreciation benefit. And then for residential buildings, depreciation is over 27 and a half years. But then again, we can split structural and non-structural components into various different buckets with different asset life depending on the category. And then what I learned I learned a lot of working with Ed, different sophisticated projects. And I'm advising one neurosurgery practice right now, and this neurosurgeon has pretty high liability. So I asked him, do you want to purchase some tax credits? And he's like, yeah, I'm not sure what you're talking about. So I said, well, I can call this tax syndicate. And I knew the tax syndicate through working with the LTC group. So I'll call this syndicate. I'm gonna purchase the credits on your behalf. And if you purchase that, effectively it will result in the discount for his tax liability, because he's gonna purchase those credits at as Ed mentioned, like 80 cents or 70 cents per each dollar of tax credit. So like this neurosurgeon goes, is this even legal? And I'm like, yeah, like we'll follow the process, and your business, his business is an S corporation, so it pertains, for his ultimately falls to his individual tax return, but he is the owner of that S corporation, benefits from buying those credits, and he gets entire dollar write-off for the credit, because credit is dollar for dollar. It's not limited by the percentage as is the case with the deduction. So it's a great strategy, it's a great planning strategy, but I wouldn't really be even thinking in that direction had I worked with Ed and learned how that marketplace works, and that it's a very good strategy for businesses to use. Then Ed mentioned jurisdictional differences, that each jurisdiction has different rules. And we have Andy Robley, who is a historic preservation consultant here in New York, and I'd like him to give a 30,000 feet view of the historic preservation tax program in New York State.
Thanks, Vasil. Okay. Yeah, I was very interested. You might have seen me nodding during the last part of the presentation there, because I was kind of very interested to hear about the vacant building tax credit and the textile tax credit. That's really awesome, and quite surprised to learn that South Carolina's state tax credit was 25%, which of course is higher than the general 20% that New York has. Yeah, I'm gonna just try to keep this under 10 minutes, but it's a pretty broad overview. It's gonna touch back on some of the things that Ed said, which I really appreciated. And I'm gonna just take a glimpse in a few other directions that relate to the economy of historic preservation. So, but with that, there's a disclaimer. I'm not an accountant. I'm a historic preservation consultant. And so I have a grasp of the incentives and challenges. My job primarily is to take people through the process of applying for state or federal grants or these historic tax credits. So historic properties, above all other considerations, are properties. They're just that, real estate. I took this photo on the right of Frank Lloyd Wright's Isidore Heller House in Chicago, which is a very prominent landmark. I thought the sign summed up a lot about just how the general public views these as real estate, but and how it can help us to frame the understanding of the economics of historic preservation. Those economics lie inside the world of real estate finance, and making blanket statements about how rehabilitation will always be more cost effective than building new should never be made, no matter how tempting it is to somebody who's biased like myself. The advantages or disadvantages of preservation are always nearly always site specific. The location, the building itself, the project type, and any other number of factors affect the numbers that go into these. There are some studies that have been conducted over the years that show that certain patterns emerge under most conditions. And these are studies conducted by the National Trust, the Department of Commerce, and the Department of the Interior. And I have some data points that I think Vasil will appreciate, because he's into data. He's always spouting off some sort of statistic or another. So here's a couple for you. Most new commercial construction projects do have an average cost savings of 4% against the comparable rehab job if the project is going on a clear lot. If raising an existing building is required for the new construction, that figure flips, and the rehab job has a range of between 3 and up to 16% cost savings over new construction. That's a pretty wide range, and that's dependent on all the factors that I just listed. And those are stats just without the advantages of the financial incentives factored in. And most of them, as we've touched on, involve some sort of tax relief in order to make the rehabilitation even more feasible. The most well-known program is the Historic Rehabilitation Tax Credit, which we've mentioned. In its broadest sense, this program gives a tax credit on a percentage of the construction costs, the QREs that Ed mentioned. The rule of thumb that I always trot out for my clients or prospective clients is that if you were to take the roof off the building and turn it upside down, anything that didn't fall out most likely is going to be a QRE. In those QREs, those tax credits, rather, has been said, can be sold, can be syndicated. I have a client in Albany who's rehabilitating a 15-story office building, and there's, I think, about $3 million in tax credits, which he's syndicated with Citibank in Chicago. And so essentially when I'm not sure how the accountancy works, but that's allowed him to get some bridge funding for his project. And sometimes that's what developers will do with those tax credits. So the tax credit program has been a large success since its creation, producing over 2 million jobs and $33 billion in tax impact. In fact, this slide's kind of old. That's probably higher than that now. Right now, the federal program allows 20% of approved construction costs for those QREs. New York State matches that with its own program, which allows another 20%, which you can combine for up to 40% of qualified rehabilitation costs. The state credit can be elevated to 30% if the project is below $2.5 million. So that was a fairly recent change that was made in order to try and incentivize smaller projects, because one of the criticisms in New York was that you have to operate at a certain scale for the credits to be feasible or for them to be accessible, really. So there's also a bill in Congress, HTC Go, which would increase the federal percentage as well. But that's not a law yet. We're all hoping. So all the interior and exterior rehabilitation work on a historic property. Well, first, let me back up. What's a historic property? So in order to qualify for the program, and this will be on screen again, and it was on screen earlier, a property has to be certified as historic. And what that means is by the end, it needs to previously have been listed on the state and national historic register, the state and national register of historic places, or be a contributing property to a listed district. Now you can, if a building is simply eligible to be listed, you can begin the process. It's a 3-part application process. And by the end of the process, the building will be listed, but it doesn't have to be listed just to start. It can be simply eligible. So if you have an eligible building and you want to start a project, contact your state historic preservation office. They're called SHPOs, and begin that conversation with them. So what a lot of developers will do in New York and other places is couple those historic tax credits with other tax credits. So there's a popular one is a low-income housing tax credit or an energy efficiency tax credit. Coupling all of these tax credit programs can present developers with very low capital costs at the end of it all. And in the end, they'll benefit from a higher return from the eventual rents charged or the resale of the building. But that, the success of all these projects It's often dependent on the education and understanding of the real estate professional or the developer. There's a widely held misconception that historically significant properties are subject to all manner of restriction and oversight. However, if you're not using federal or state funds to complete your project, like a state grant or a federal grant or tax credits, you can do whatever you want. You can remodel, alter, paint, subdivide, sell, or even demolish the building. If you're using state or federal funds or tax credits or need to get some sort of state permit, that's when the government has oversight over your project. So listing on the district is seen as an investment on the part of the taxpayer because they've found an additional value to that property. And so the government's job is to protect that value. And so, one line I repeat to skeptical developers or people I'm trying to educate about the program is that the National Register and historic preservation, a lot of the rules are there to protect you from the government and government intervention, not to impose it on you. So if there's a big energy project in your neighborhood or a Department of Transportation project that's going to demolish a bunch of properties, that's what it was made for, to create a kind of review to protect things that we value culturally from that demolition. There is an aspect that sometimes confuses people, and that's because there are often two parallel but very similar types of designation. There's the state and the federal designation, and then there's a local designation. The local designation often has a lot more power over the use of your real estate. And that has to do with, the Constitution, which gives land use power to the states, and the states devolve that onto municipalities. So if a municipality enacts a historic ordinance, it then has the police power over the use of real estate. Federal government doesn't have that. So they can step in to protect the property from government action or the use of government money. But other than that, they have no say. If you live in a local designated district, then that's when you have to go before a review board, and they have all sorts of rules you may have to abide by. And that just gets confusing sometimes because often nationally listed historic districts will be coterminous with a local district. So it'd be the same boundary, but two different designations. All right, so I'm kind of yammering a little bit. Let me just get right down to the details here. In order to be eligible for the tax credit program, in New York State, there's the commercial property tax credit program, which couples with the federal, and then there's a homeowner's tax credit program, which I'll also talk about. So in order to be eligible for the historic commercial properties historic rehabilitation tax credit program, you must own an income producing property. It must be listed or be in the process of being listed on the state and national registers of historic places. In New York, if you want to get the state credit as well as the federal credit, the property has to be located in a qualifying census tract, and your SHPO will be able to tell you whether or not your property is located within one. Then there's something called the adjusted basis test, and that essentially is there's an equation which I can read the words here, but I would say call your accountant and they'll figure it out for you if you pass the adjusted basis test. Typically, if you're outside of New York City, in New York State, you'll pass it. It gets a little bit more complicated in New York City where land values are so high. You have to follow what's called the Secretary of the Interior Standards for Rehabilitation. And all that really means is, since you're using historic rehabilitation tax credits, you need to historically rehabilitate your property. So you can't completely renovate it and make it look like a 21st century building if you're working on a 19th century textile factory, for example. There are things that will be designated as character defining features. And those are arrived at largely by a consultant that you might hire in conversation with your SHPO. But things like windows are extremely important. The number of bays that a building has. You can't substantially alter how the building looks or operates. Essentially, you need to be able to stand in front of the building or stand inside it and recognize what it was historically, what was its historic function. You can add new construction to a building, but those don't qualify for credits. And there's a few different rules set forth by the Secretary of the Interiors on how to appropriately do that. So typically your SHPO and certainly the National Park Service has all this information available on their website as well. So I do want to just quickly touch on New York State's historic homeowner rehabilitation tax credit. If you own a house that's listed on the National Register and it's located in an eligible census tract, you can qualify for a 20% tax credit from the state. You have to live in the house. The repair costs must exceed $5,000 and you must spend at least 5% on exterior work. And it has to be approved by a SHPO before you begin. So this is important. You cannot start a project and halfway through apply for the credits under the assumption that what you're doing will qualify. You really, and I stress this with people, with my developers, they don't always listen because it goes for the commercial tax credit as well. Get your plans ready and seek approvals before you begin work. Otherwise, you might end up being very unhappy. So just one more slide I want to go through, and this is more of a macro view that I just like to show people to kind of demonstrate the impact of historic preservation on the entire community. One misconception is that new construction must be supported to encourage job growth. However, data at the national and state levels disputes this. There's something called the regional input-output model, which is used by Department of Commerce and other economic development agencies in the US, shows that rehabilitation holds a slight advantage over new construction in terms of that economic impact. This slide right here demonstrates the slight advantage nationally and at the state level. It's a little busy, but what's really most important is the information about jobs and tax impact. So if you look at the bars, you can just simply look at where they stack up. Historic preservation is blue and new construction is this orange color. So for every $1 million spent on the non-residential construction sector, we can see that 38 jobs are created as a result of rehabilitation versus 36 jobs for new construction. That's at the national level. At the state level, I'm talking about New York, that's 19 jobs for preservation or rehabilitation and 16 and a half, which, there's no such thing as a half person on a construction site, but this is just to demonstrate that more jobs are made through preservation. And that's really due to the nature of the work. It requires generally a higher level of skill and takes more time. So it results in greater employment. In addition, tax impact, there's also an advantage. For every $1 million spent in this residential construction, there's a tax impact of about $110,000 for rehabilitation versus $103,000 for new construction. So that's the that was my rush through the 30,000-foot view. Hopefully that was useful, and thank you for having me on here. It's been a learning experience. So
Yeah, thank you so much, Andy, for providing this excellent overview how the program operates in New York State. And when Andy was talking about preserving character defining features, I want to do a little segue into facade preservation easements. Those,
Vasily, can I jump in for a second?
yeah, go ahead, please.
Yeah, you kind of jogged my memory a little bit, Andrew, because I was looking at a specific project when you were speaking about the percentage for South Carolina versus New York. And the spreadsheet I was looking at to kind of refresh myself was one of our smaller projects. So the way the South Carolina credit works is you can get a credit of 10%, or you have the option of a 25% credit as long as it does not exceed $1 million credit for each certified historic structure.
I see.
And so we'll do the project on multiple adjacent historic structures. For some of our smaller projects, we'll be able to split up to $1 million credit for each structure and take the 25%. Whereas on some of our larger projects, we'll have the 10% South Carolina credit.
Yeah, that's interesting to hear that. You mentioned earlier, Ed, about how municipalities were different, and the states are different too with their credits. So that's kind of an ingenious method to capture that credit on your part. And they're all different. Like, I know New York, of course, I explained, but some of them are like so limited. Massachusetts, for example, they earmark only a certain amount of money to be a certain threshold to be made available for tax credits. And then on top of that, it becomes a lottery. So your project, like, you have such a low chance of it even qualifying for the state tax credit. It's ridiculous. Whereas luckily in New York, if you're listed, you can use the credit. And
yeah, it sounds like the immigration process, each country gets like 7,800 quota. So so it becomes like a lottery system.
yeah. And this is quasi related. I just want to throw that out there before you go on. But historic preservation consultants like myself are seemingly rare, even though it seems like there's more and more work. There's less and less people with this training to do it. So, for example, a colleague of mine recently took a job at the Arizona SHPO and telling me there's essentially no consultants out there. So if the people watching this video go get a preservation, you can just get a certificate. You don't even have to go to grad school. But if you head out to Arizona, and you'll probably have plenty of work.
Yeah, so thank you for this.
It's very complex. I can relate to the advice to developers to figure out if you qualify first. We always use a historic consultant who's an architect, and then we do so many real estate projects that we have an architect on our staff who's always coordinating with the builders and the historic consultants to make sure that we have a good plan in place, and then we get the final approvals. And it seems like at the end of a project, there's always a few things that we, after construction, need to tweak a little bit to make sure it meets the federal department specifications to resemble the original use of the building.
Sure.
And I usually don't get that in depth, luckily. I just am responsible for the accounting, but I know it's a very in-depth process.
Well, if they didn't have any comments, I don't think they'd feel like they're doing their job. That's the impression. I get.
That's true.
Yeah, thank you for these additions and caveats. And like I want to comment on Andy's point about preserving character defining features of the historic building. So that is actually a good segue into facade preservation easements, where the facade of the building must be preserved to match the historic character. Well, those are very complex, and the IRS, in fact, annually includes those on the list of a dirty dozen tax strategies. So that shows you that there is a lot of abuse in the area where companies don't claim it properly. However, it can be done and claimed properly, but it requires very careful planning and legal mitigation strategies. So, like usually when you work with the tax syndicates on that, they will say, "Yeah, we know that the audit is inevitable, is virtually inevitable from the IRS. That's why we have an extensive legal team specializing in facade conservation easements to protect and defend you during these audits." So I work with Maria and my wife, who is a lawyer and is like specifically admitted to the tax court. So we do have the resources for legal mitigation strategies for things such as facade preservation easement. It's just acknowledging the landscape that yes, there are cases of abuse in this space. However, it doesn't mean it cannot be done properly and structured properly in the right legal manner. So it goes back to choosing the right federal tax credit, and there are in tax, one of the most common terms is facts and circumstances analysis. What can be right for one company is not right for another company. And so it's evaluating which ones would be the right fit for this specific entity. When we talk about investment identification process, it's like a step-by-step process must be undertaken to find the suitability of the most appropriate credit for a specific investment at hand, considering factors such as income type, timing, credit type, investment structure, tax implications, projects, and due diligence. In taxation, there are four most important concepts. If you understand these four elements, you can get pretty good handle in taxation. So the four elements are nature of tax, character, timing, and jurisdiction. So nature of tax is taxable and non-taxable. It's a very simple division line there. Then we talk about character. If we have ordinary income or capital gains, and then timing, we were talking about depreciation. So it's depreciation, like in one period can be higher because and another one lower because we can use different tax depreciation methods. So that would be an example of timing changes and how the tax attributes change from period to period. And like when we talk about such tax attributes such as net operating losses, in the CARES Act, for example, open the possibility of carrying back net operating losses 5 years back to the profitable year. So like I advise some clients on amending prior year tax returns and carrying the huge losses from 2020 to the profitable years, resulting in big refunds. So we talk about different tax attributes such as deductions deductions, credits, net operating losses. So it's all the example of tax attributes. And then the final element of taxation is jurisdiction. And as we were discussing here, like different jurisdiction have different laws, and especially here in New York City, we have the separate taxation system. So there is only a handful of cities in the USA with the separate taxation system. In New York City, Yonkers, and Detroit being some of the examples, with the cities that have their own tax systems. So that makes it like fertile ground for tax consulting. Then touching briefly on the individual taxpayer considerations, there are also different types of credits available for related to investing in those credits, and then limitation of credits to offset passive activity income. That's what known as passive activity rules, because there are three main tests in taxation when it comes to the deductibility of losses. The first test is basis test. We must measure against the basis in this property or in this holding, and then we have at risk amounts. Is this amount at risk? And then finally passive activity rules, so-called PALS, passive activity loss rules, that are deducted in a certain order and in a defined fashion. Individuals, like exceptions for individuals, include the historic rehabilitation tax credit and material participation rules. That's some of the exceptions that can help use the historic rehabilitation tax credits as an offset to regular income. In certain instances, it doesn't have to be passive against passive, which is a general norm. So for corporate considerations, investing in tax credits reduces effective tax rate, and it also ties into the ESG initiatives, because a lot of the companies right now want to they want to be ESG friendly, meaning they want to have environmental, social, governance impact. But some of the companies don't really want to get involved in the nitty-gritty of very specific projects and all the associated work. So one way to be invested in social responsibility projects is through the purchase of tax credits. So if the company purchases tax credits related to the projects in the social space, and Andy was mentioning low-income housing tax credits. So investing, if the company purchases credits like that, so even though it does not participate in the project directly, but by virtue of investing in these tax credits, the company becomes ESG friendly. And then we have considerations for closely held or S corporations. Since those entities are flow-throughs, the tax attributes would ultimately appear on the personal tax returns. Those considerations would be similar to individual tax considerations. Then we talk about different tax credit investment opportunities, and we can mention investment tax credits, historic rehabilitation tax credits, low-income housing tax credits, and new market tax credits. That new market tax credits is relatively new, like a couple decades or so, but Andy was talking about specifically designated census tracts, and there is a very good company called Novogradach, and they have very sophisticated maps helping determining whether based on the project zip code, whether that area would be eligible for new market tax credits. When we talk about the most recent impact on the tax credit space, it was the Inflation Reduction Act of August 2022, known as the IRA in short. And this tax credit really was a game changer to the tax space, because it made a lot of credits refundable. And it introduces a direct pay provision, allowing tax exempt entities to monetize on these tax credits, because before the IRA, nonprofits were effectively excluded from benefiting from tax credits, but not anymore, because the IRA created a pathway for nonprofits benefiting from these tax credits also. Now the nonprofits can also treat these tax credits as overpayment of taxes and receive direct payments from the US Treasury. Now, hence direct pay provision. And higher education, you see it mentions local governments, hospitals, and higher education institutions are eligible too. Now these entities, nonprofit entities, can pursue renewable energy projects, and then they could reduce payback periods for projects because of these cash infusions into these entities. And so the expectation is that these initiatives and these changes to the tax law will lead to increased development of microgrids by local municipalities, hospitals, and higher education institutions. And microgrids are defined as self-sufficient energy systems that serve specific areas, providing power independently during centralized grid outages. Yeah, and like when I visited Amish country a while back, I was fascinated by their autonomous systems for lighting, and then they became so indispensable in Ukraine when Russia targets critical infrastructure, and these microgrids and the use of the autonomous energy systems becomes very important. The IRS incentives make investments in renewable energy feasible for a broader group of tax-exempt investors and developers since the IRA. This is it in a nutshell. So we'll see if there are any questions here, any clarifications or points.
I do have a question for Andrew.
Yeah, go ahead.
So hi Andrew. So when you were talking about the historic preservation credit and how the buildings have to be in the historic preservation list, I might be mistakenly mispronouncing it, but yes. So is there a period in which that building has to be on that list, or a newly entered building in that list would still be eligible?
Thank you. No, there's no probation period, if you will. In fact, if you recall, I mentioned that you can actually start the application process when the building is still eligible for listing. So there are, let's say that there's two types of buildings that are not listed on the National Register and buildings that are listed. When an unlisted building wants to become listed, it first has to pass through this intermediate stage where it's eligible, which means it's not on the register, but some of the protections and incentives for listed buildings apply to it. And it means the government has recognized that it could potentially be historic. So once that first step is becoming eligible, you can begin the application process at that point. By the end, in order to capture your credits, the building must be on the register, must be listed officially. So you can start a project with a building that was listed 20 years ago, or you can start with a building that's simply eligible and will end up being listed by the end of the project. So just to dial down a little bit to expand on that, the historic rehabilitation tax credit application process involves 3 parts. The first part is the certification. And so when you write that certification, when you hire a consultant to do it, you're essentially writing the listing document. That's what the part 1 is. So by the time you move on to the part 2 is where you provide the plans and the description for all the work that's planned. By the time you move to that part 2, the building is ready to be listed. And then when you move to the part 3 is the recapitulation. So it is you proving that you've done what you said you were going to do and adhered to the Secretary of the Interior standards. So that was all extra to your question, but no, your building could be, doesn't even have to be listed to start the process. It only has to be listed to capture those credits at the end of the application process. And sometimes the building being listed and the project application being completed are the same time.
Thanks for the additional information as well. Thanks.
Well, thank you. Thank you for the fruitful discussion and overview of tax incentives and credits. And I'll have this scan and fill out the form, especially for people watching off of the YouTube channel. If you want to get started and do the review, see what tax incentives may be applicable to you. There are multiple ones, as we discussed. We'll be happy to evaluate what tax credits you may avail yourselves of. Thank you so much for the discussion today, and thank you to all the participants for great and valuable input.
Have a good night.
Yeah, good night.